You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Thank you, Jim.
The big news of the day, OPEC decides to keep the oil taps wide open, and we're seeing oil prices plunge before our eyes. Now, we know there's a benefit to the consumer with lower gasoline prices, but what does it do to the Canadian economy overall?
Yeah, well, there's definitely a benefit. Lower prices. I'm all for this, by the way. Lest I come off sounding at all negative about this, this is one of the first free market forces that have been allowed to show its face, or that have sort of had an impact on prices in the last little while, because it's been so controlled by riggers on various sides. So you have people controlling the copper market and not letting the price of copper drop below $3 a pound. You've got, the central bankers pumping liquidity into financial assets in general, trying to keep everything looking really rosy, all while the global demand picture continues to decline quarter after quarter after quarter, and you have recession resume in places like Japan, and you got Europe on the verge of another recession, and all this stuff happening, and yet you have this disconnect in financial assets, which has been to do with these, as I say, extraneous forces that are not supposed to be driving the bus, but have been sort of manipulating and controlling things to the upside. So what you have now is a capitulation phase going on. And it's very exciting, actually, Jim, because I knew it was inevitable, but it's been remarkable how long some of this stuff has been able to sort of rig it along. So if you look at what's happened here, we've had a huge surge, a 56% jump in U.S. Oil and gas production in the last 6 years, at the same time that domestic demand, even, at the peak of the so-called recovery, still down about 10% from where it was in 2007 before the great financial crisis. So you have this huge excess capacity that came online, not just in America, but also in places like Mexico. In most of the major oil producers in the world have been able to access product that they couldn't do before they had some of this recent innovation. So you've got a huge surge in supply at the same time that you've got weakening demand. And so for a while, prices were levitating higher than that supply-demand picture dictated on an organic basis. But you've had recently, I think it's a cascading effect, really, because if you notice, the metals mining materials space has been in the throes of a 3-year-long so far, drag out liquidation, and it's really starting to pick up steam. I had an article I put on this week about the fact that secular bear periods start from these lofty valuations and over-optimism, and they grind down over a period of years to the lowest valuations and the least optimism, right? So you're seeing that in the metal space. It's like instead of being cocky and euphoric, people end up being just surrendered to the fact that it's been a complete mess and they lost a ton of money and they just want to write things off and take losses and move on. That's what you're seeing in those other sectors. But so far, the energy sector was really kind of sitting on the fence. And with OPEC not stepping in today at their meeting to cut supply, you had that capitulation effect going on in the oil market, which has already been falling, Jim, with global growth again since May. And our work suggested, when it broke through $80 a barrel at the end of last month, that was significant, because that was the secular uptrend for oil prices that had been in play since the 2001 recovery. So when oil prices were last at $10.92, that was in 1999, and they've been on basically a 15-year climb to a ridiculous peak, with the credit bubble in '08, around $145 a barrel. But even when it came back down in the '08 recession, it stayed around $40 a barrel, which was the long-term support. So as the QE stuff's gone on the past few years, and you saw renewed speculation and liquidity driving up asset prices, we were continuing to watch the price of oil as a barometer, knowing that it should reconnect at some stage with the weakening, global growth picture. And so, in fact, it did. When it broke through 80, it was actually challenging that secular trend that was in play since 1999, And now we're below that today, Jim, right? We're well below that. We're into the 60s today on WTI. So all this is connecting with our assessment of the global economy, which is that it's in a contraction mode, and that the greatest risk now lies in the areas which have been the sort of star turns of this recovery, right? If you think about it, the U.S. story has been one of the bright lights in this slow global growth phase in the past few years, and most of that has come from the revolution of the energy sector. So a third, here's some statistics for you, a third of the capex of the S&P 500 companies comes from the energy sector. You know, the lion's share of the jobs that have been created off the 09 since 2009 have come in the energy sector, right? So a bulk of the tax revenue that comes from the energy sector. So it's extremely important, and that's why I say, although there's a benefit to consumers in the lower price, when you look at the overall GDP of the country, and it's the same with Canada, Jim, as you know. When you look at where the big boom areas have been in Canada in this past 5 years of this so-called recovery, it's all been around the energy patch, right? So you've had Newfoundland, Labrador, and in Alberta, and some parts of BC and Saskatchewan, and that's where the boom has come. And then you've got the reciprocal boom of that, which is in finance, because the banks underwrite all of the energy that is the driver of our economy, and the banks go along for the ride. But when you look at that sector now, they're not able to sell securities like they were hand over fist because people are turning away from the sector because the math no longer is positive at these prices. You know, most companies have factored in $100 a barrel and higher for their capex plans, for their dividend plans, for their expansion, their projects. So we're way below the break-even cost on most of those plans here, and that means that people are not going to be keen on these securities, which means banks who've overlent and have a lot of the exposure are going to also suffer in this decline. And that's the only two things that have been holding up the Canadian stock market, right? Finance and bank shares at all-time highs, and energy, which was already weak and is now basically capitulating.
Calgary real estate likely to take a hit?
Well, there's another thing. Okay, so excellent point. The other stool, if you will, of the Canadian recovery, so to speak, has been this boom in the housing sector, which again, if you look at where that focus has come from, it's been primarily concentrated in the hot spots in the West and in Toronto. So think energy and finance, right? And also the domestic debt bubble, let's put it that way, where consumers have really done themselves a great disservice by loading up on debt and over-investing in high-valued assets in the housing market. So, yeah, that's all connected. It's when you get a downturn in revenue. I always say this, lots of cash flow when times are booming. That's not when people learn fiscal discipline. They learn fiscal discipline when the cash flow begins to dry up. And that's when they say to themselves, oh my God, what were we thinking? Why did we take on such a high cost structure? Why did we commit to these payments? Why did we, borrow all this money, buy all these expensive assets? And then the system, it's very, this is what companies do. This is what families do. The first step when they get into these cash crunches, which is where the energy sector is right now, is looking at the math and saying, gee, oil $70 or less. Wow. A whole bunch of these plans have to be rejigged. Now, they'll go into it assuming it's a short-term blip, right? This is what people coming off a boom always think. Well, prices will be back up shortly. So right now, we'll just get through the next quarter or two, and we'll first of all start by cutting some of our capital spending plans. That's the quickest thing. They decide, okay, that's easy. We'll just say we're delaying some of these projects. That's the first thing they do. But then when cash flow doesn't rebound quickly, they say, okay, well, let's sell off anything that's not core or essential to our business, any, in quote, investment properties or investment assets that we may have that we don't really need for our core operations. They sell that off. Then they realize they're still running out of cash, and then they start, downsizing. They look to let go workforce, and that starts to become much more public and controversial. And then, as things finally grind them down, they start realizing that they've made bad investments, that they shouldn't have been buying back all their own shares when cash flow was good, because that's actually not a lasting benefit, and the shares have fallen. So now they don't have any actual liquidity to go to. So then they start taking right down on assets, admitting mistakes, writing off projects, firing CEOs. This is all part of this great cleansing process. And I think that, you're going to see layoffs in the sector, and that means slowing growth in Canada as well as the U.S. And we have been, as I say, sort of the bright light in the global economy. So we're probably looking at a significant decline in profits for major corporations in North America. And, this is why, whether we get a technical recession in the global economy, the price risk is all in the investment markets right now, because they have been so overjuiced, so over-optimistic, and reckless in their valuations. And all of these factors tell them that growth that they thought was rebounding, and it kept always hoping that the next quarter and next year would have much stronger growth, it's no longer even feasible to make that argument in this environment, because we're clearly in a slowdown phase, and profits are clearly going to be under significant pressure. And that means that those garish valuations that were already ridiculous are just that much more ridiculous.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. A recent survey of Canadian small businesses said something like 78% of them expected to expand in the new year. Does this recent economic data throw cold water on all that?
That's an interesting stat, actually, because the U.S. Stat is actually the opposite. I was just looking at that. The companies expecting to invest or expand their business in the next 12 months is today at the lowest level that it's been since the 2009 recession. And that actually is not just the U.S., that's the Global Business Activity Future Expectation Survey, too, said that they have the lowest percentage of companies expecting to increase their business over the next 12 months. So I don't know, Canadian companies, I think, are probably still, as I say, on this oil kind of sugar high, where they have really dramatically misunderstood and misassessed the demand portrait. And so they're factoring in assumptions of, $80, $90, $100 oil. Here's an interesting stat. Half the industry needs more than $120 a barrel to be viable. And, the weakest quartile needs over $130 a barrel. And we're half that today, Jim. So, I think that they may start out with, as I say, very optimistic, bold, a forecast of what they're going to be doing, but when they look at their cash flow, and if it's not going to be a short-term blip, but a sustained period of pressure on cash flow that will last the next few years, probably, by the way things look to be going, then I think you're going to find them capitulate on some of those plans.
Also, too, the demand for oil to power vehicles is going to decrease in the near future. Electric cars, hybrid cars, are much more popular than they've ever been, and people are looking at a dramatic spike in that. And even with lower oil prices, driving your car using electricity is still much cheaper, even with cheap oil.
Sure. And there's also, that's one of the trends, certainly the cost of energy, but there's already been a trend towards less cars and consolidation of sharing cars. A bunch of programs are coming out where people, certainly in urban centers, are doing, either more of the Uber style, taking public transit, but also literally buying cars in conjunction with other people where they share them. So I think this is part of this trend away from spending to try and consolidate expenses and pay down debt that the consumer's been sort of thinking about in most places other than Canada, and we've still got that to come, I think. But they've been, trying to figure out ways to cut spending because they just haven't seen the wage growth in the past few years. So I think that'll continue, and it's not just efficiency, it's not just substitution of other types of energy, which is going on in some of the more alternative fuels available for different applications in the world, but it's also this generational downshift. It's this demographic weight of older people who are traveling less, and just the younger people not wanting to spend as much and not having the spending power because of their poor employment situation. So I think we've seen peak car consumption for the next few years. We've also run the full gambit of whack job financing stuff again, Jim. As you know, it's been just craziness with giving a car to any person that happens to walk by.
Danielle, well, you're the first to mention on this show that people offering 8-9-year car loans were crazy. Finally, I saw the Financial Post do a story on it very recently, so you're ahead of the curve on this as well.
Well, it's just basic math, right? It's a depreciating asset. They are really designed to be depreciating and to lose value rapidly, and people are locking into these long-term loans, 8 and 9 years. It's bad for them. It's bad for their spending power over that period. It's also bad for the companies that are trying to pump that product. They've really shot themselves in the foot, so to speak, because in a desperate, drive to get a car onto anybody that can have one, they've really undermined their growth for the next few years because there's just going to be less people able to go out and buy another car. The other big impact, which I think we must not overlook here, is we've been through this period of what I've called peak central bank mania, where people believe that central banks could control all the free market forces and, create inflation out of thin air. And so they've done all these stimulative programs the past 6 years, wasted all this good money after bad. And at the end of the day, this plunge in oil is just going to compound the already heavy weight of deflation that's going on in the world from the toxic levels of debt, from the aging population, from this sort of retrenchment of consumers, from the fact that they can't do any more of these, the exotic securitization stuff there's just no more market for that. So you have deflationary effects that are going to pick up steam again. So it's interesting because that's why Japan said they were going to do more QE, right? Their recent report found that they were back in recession and that inflation was very weak again, and the same thing for Europe, right? And so Draghi said, don't worry, we'll figure out a way to do some QE. We got to get some inflation going here. Well, guys, you're not getting inflation going, and this plunge in oil, I think, is going to be the final nail in that coffin of that argument that they can actually create this out of thin air when all the forces of the world are in mean reversion right now, right? So that's the age is in mean reversion as people get older. It's the ability to spend that was so overstated in the credit bubble is now making its way back below mean. Prices like oil and commodities and other things that were way overvalued because people could get credit are now making their way below mean. I think these are all very healthy trends, but I do think that they win the arm wrestle completely and make it evident that central bankers are not able to control the things that everybody's been giving them credit for. And that will be a wonderful development because free market forces are the answer. They are the cleansing mechanism that allows us to take out bad investments and managers and put resources where organic demand actually lies. And that's the process that's going on right now in energy, and it's already gone on in commodities, and we're much further along in the cycle in some of the metals and mining. And now I think we're going to look at that. The finance sector remains one of the most overbloated, toxic weights on the global economy, and I think we're going to go into the mean reversion phase there as well, which would be a wonderful thing. So it's all very positive. It's just that if you're not prepared for it, if you're pretending this isn't happening, if you think that asset prices can stay at these, ridiculous levels, notwithstanding all the actual organic forces that are at work in the world, then I think you're in for a bunch of heartache here. And that's why I've been trying to warn people, you don't stand in the way of this stuff. It's much bigger than any of us. Nobody has enough money to control the forces of these trillions and trillions and trillions of dollars of global markets. So you really do have to just respect the trends and make your own sustainable financial plan and try and just resist all this speculative fury around you, because the speculators always end up the same way, right? Bankrupt and gone, and it's he who can survive the cycle who will live to profit, and that's what you have to design to do.
Will governments resist the temptation to use that old phrase, too big to fail, again? I mean, they're saying you bailed out GM. Did you get a good return on it? No, you didn't. You bailed out, all these other car companies. Did you get a good return on it? No, you didn't. What about all the banks? that were bailed out. Are we going to see that again, or will they be allowed to fail if they haven't done a decent job of investing right now?
Well, I think that is highly more likely this time than the last time, and the reason is simply math-based. Not only is, as I said, the bulk of the growth in the world and the tax revenue and the jobs, everything has come from energy in the past few years. Now that we're in mean reversion in that sector, you're going to see budgets don't make sense in a lot of countries today. Venezuela and Russia is a complete disaster, right? The Russian ruble's fallen more than 90%, Jim, just since June against the U.S. dollar. The Venezuelan government needed something way north of 120 a barrel just to even balance their budget, never mind, get out of debt. So I think there's high likelihood of defaults in certain governments, and I don't think they're not gonna have the coffers this time. The Canadian government, again, very pro-energy, very optimistic on that sector, has not got a balanced budget the way they thought they did now that prices have changed. So I think liquidity just evaporates in this. The expectation of slush fund that people thought they were going to have in budgets aren't there. They go from balance to deficit in a heartbeat in this environment, and it's very rapid. And I think that's the thing that, all banking crisis or financial crisis has always come from after periods of great economic boom, where a lot of capital flows have transcended borders, right, have come from other places. So if you think about Canada again, the belief in the commodities boom and our sort of belief that we were so much better because of our Rocks and Trees Foundation basically brought all this international flow into the country during the boom up to 2008. We had huge overinvestment. We had a very strong currency. We had huge capital flow into our real estate markets and our security markets. Well, that trend has been reversing and mean reverting ever since. And I think that this plunge in oil and the problems in the energy sector, our energy companies and a lot of people have been holding these income trusts in the energy sector thinking they were getting away with something in a low interest rate environment. That stuff's all highly vulnerable in this. And I think that will scare people. Not only is our currency falling, but foreign investors don't want to hold things that are falling, period, but currency falling along with the value of the assets is going to be something that sees more flows out of our country, and that's going to create more budget constraints and stresses. So, it's classic textbook. And this is why I try and say it shouldn't come as a surprise to anybody, and yet it probably will take most people off guard.
Danielle, I know we can go on for another hour about this, but we have future shows to do. I'm just wondering if the federal government, which is promising something like $28 billion in tax cuts over the next 4 years, have they made a promise they just can't back up now, or are they just going to stick to it at least until they get reelected?
Well, unfortunately, it may be the latter, right? The political goal of getting reelected may, lead the politicians to continue with that promise, and it may lead, willfully blind constituents to vote for that. But I think that if you want to live in a sort of a offensive and on guard and ready for the future kind of mode, you have to look at math. And if it doesn't make sense to give more tax cuts right now because your revenue side's imploding, then surely you shouldn't do that, right? Surely that's foolish financial management. But I'm afraid that there's more of that these days, on both sides of the aisle than there is of any other kind. So the tragedy is that people, when these secular shifts happen, and make no mistake, Jim, this is a secular shift. The secular climb in oil that created certain capital flows in the world over the last 15 years is mean reverting, okay? That means we're in for an entirely different environment in Canada than we had over the last 15 years. And that means that all the math should be up for a different scrutiny. And you shouldn't expect that things will bounce back and it'll all be back to, quote, normal any day now. We're into a new normal.
Carol Taylor, when she was finance minister of BC, said she had nightmares about the price of natural gas. She says a 1 cent swing in the price of natural gas meant millions and millions to the BC government. Can you imagine now how she would feel?
Right. And then, because there's so much leverage in financial markets, I mean, you see things like oil down now 6% just in one day. The energy sector shares, as I said, down over 10% just in 1 week. That's the kind of rapid move, and it's that rapidity that the global markets have so much trouble adjusting to, because so many of the players and intermediaries, so to speak, are highly levered. So they lose chunks of capital rapidly, and then they have to start selling other things, and it creates a lot of shock. So I would be expecting to see knockoff effects and shocks to the system from this over the next several months at least.
And good times for bargain hunters.
Well, it may take a while. If this is a true secular capitulation, it will not happen in weeks. It will take, months, if not a couple of years to complete. But once it does, boy, that's a really exciting thing.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Thank you very much for being with us.
Thank you, Jim.
You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can forward questions and comments to info@HowStreet.com. We're also up on YouTube at Talk Digital Network. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.